you're looking to buy a home or refinance your current home and you don't understand the mortgage process, you're not alone. Most people think it's just apply and get approved or declined. They don't understand the steps that take place before you submit that application that can bolster your chances of an approval. Today, I'm going to break down the mortgage process from a lender point of view, telling you exactly what they look at and how you can structure your mortgage application to increase your chances of approval. I'm going to tell you what lenders look for, documents needed to verify what they're looking for, and how to get approved faster. First thing that lenders look at is credit. And we're not just looking at your credit score. We're looking at your whole credit picture. Your credit score is a reflection of your repayment history, your current debt levels, basically a snapshot of your last few years of credit history. What lenders are also looking at are your monthly debt obligations. On your credit report, it's going to include how much you currently owe lenders. Equally, if not more important, the monthly obligation that you have to them, or your current monthly payments. In Canada, to work with an A lender on a conventional or an insured mortgage, you're going to need a minimum credit score of 680, a strong repayment history, and the capacity to make your debt payments. More on that later though. The second thing lenders are going to look at is your income. How much money do you make, and how are we verifying that? If you're an employee, we're going to need a job letter, your 2 most recent pay stubs, and the prior 2 years tax documents, T4s, notices of assessment. If you're self-employed, it gets a little bit more complicated and will likely need to use a 2-year average. That goes for overtime and bonuses as well. Self-employed individuals or corporation owners can expect additional verification documents, starting with the prior 2 years tax documents, corporate bank accounts, proof of ownership, and proof of operational existence. The third thing lenders look at is a combination of the first and second thing we talked about, the amount of debt payments you already have and the amount of income you have coming in. And we look at this on a monthly basis. This is simplified into debt servicing ratios, total debt servicing and gross debt servicing. Gross debt servicing is the total housing costs divided by your total monthly income. The principal and interest, your mortgage payment, property taxes, and a heat calculation divided by your monthly income. For an insured or conventional mortgage with an A lender in Canada, your gross debt servicing ratio needs to be under 39%. Lenders also look at your total debt servicing ratio, and this is where what we talked about in step 1 comes into play. To calculate your total debt servicing, you take the property expenses and add to it any other current monthly debt payments that you're making and divide that by your total income. This ratio needs to be under 44%. Sometimes on mortgage applications, you can have shortfalls in areas that we can explain away to a lender. Debt servicing ratios are not one of them. They're pass fail. The fourth thing that lenders look at when trying to get that application approved is your down payment. How much is it? Where is it coming from? And do you have source documentation for that money? Now, savings accounts, checking accounts, tax-free savings accounts, even RRSPs are all acceptable, but there's going to be different document requirements for each of those down payment sources. At a minimum, we're going to need a 90-day history via bank statements, proving that those funds belong to you. Yes, you can use a gift from family. Yes, you can withdraw from RRSPs, and there are other programs available to help you put together that down payment. Just expect more document requirements and potentially an impact to your debt service ratios if you're borrowing that down payment. One of the biggest surprises for buyers in the Edmonton and Calgary area is the need to show proof of closing costs. Lenders require anywhere from 1 to 4% of the total purchase price available for you to have at closing. You don't actually have to give the lender this money, but you do need to show that you have it available. This covers such things as appraisals, legal fees, title costs. Last but definitely not least, lenders are going to take a strong look at the property that you're purchasing. This is, after all, the collateral for the loan that they're going to be giving you. They're definitely going to want to confirm the market value of the home, the condition of the home, and its overall resale potential. All of this can be accomplished through an appraisal. Some lenders have an internal appraisal process, but you may require an external appraisal to come in and have it done for you. If you can structure your application to accurately and completely portray your income, credit, down payment, and the property, there's a high chance of you getting approved. And I stress the word structuring. For example, if you were looking to put down, say, 15% on the property, but you don't quite meet those debt servicing ratios, we can take from that down payment, potentially pay out one of your lines of credit to reduce your monthly debt obligations, increasing your purchasing power. The structure of the application does matter. And if you understand this, we can control the outcome of that application. If you live in Alberta and you want to know what you can qualify for and what you can ultimately get approved for, I can help you realistically map that out. Follow for more daily mortgage insights. And if you're looking for a mortgage and want a personalized financial review, click the link below. And this is how you get a mortgage in Alberta.